If a government owes trillions of dollars, the easiest fix seems obvious. Just turn on the printing presses, create $1 trillion out of thin air, and wipe the slate clean. Or think about prices. If the cost of groceries and rent drops every single month, it sounds like an absolute dream for consumers trying to save a paycheck. And when a country faces unfair trade practices, slapping a massive 25% tariff on imported goods feels like the perfect way to force a foreign rival to pay up. While these ideas align with how we manage a personal bank account, they fail at the scale of entire nations. Every one of these intuitive rules operates in reverse when applied to a global economy, requiring us to unlearn what we think we know about money. A currency's exchange rate functions as a live marketplace, measuring global trust in a specific country's economy. It fluctuates based on how much value that country produces and how many investors want to hold its notes. This banknote reveals the result of printing cash without matching economic growth. In 1923 Germany, the government printed so much money to pay debts that the currency evaporated. Citizens needed wheelbarrows of cash to buy groceries because a loaf of bread cost 5 billion marks. Falling prices freeze economies. Expecting a car to be cheaper, you wait to buy. When millions do this, revenues collapse. Companies cut prices and lay off workers. This leaves consumers with less money, creating a self-feeding loop that locks the system into paralysis. Trade barriers work similarly. When a government puts a 25% tariff on imported Chinese steel, the U.S. government collects that tax at the border from the American company importing the materials. The foreign supplier still receives their full asking price. To maintain their profit margins, the American importer raises the price of the finished cars or appliances they build with that steel. Whether it's the dilution of the money supply or the imposition of border taxes, these macroeconomic maneuvers eventually pass a hidden, higher cost directly to you at the checkout counter. These United States savings bonds show that national debt functions as a system of tradable IOUs. Governments fund roads and hospitals by selling these bonds to their own citizens, pension funds, and other nations, who hold them as safe, interest-bearing investments. In the housing market, the role of the family home has evolved. In 1970, a single middle-class income could cover a mortgage. Today, institutional investors treat houses as high-growth investment vehicles, buying up supply and driving prices to levels that price out regular families. This chart compares how groups handle wealth. While most avoid debt, the wealthy use it to multiply holdings. Selling stock triggers a massive tax penalty. Conversely, borrowing against that stock yields tax-free cash for new ventures, while the original investment continues to appreciate. The financial system rewards those who already own assets by allowing them to use debt as leverage. This creates a divide where those with wealth borrow their way to more, while those without it struggle to pay off high-interest consumer loans. Because traditional money relies on trusting central governments, Bitcoin attempted to replace that trust with math. It uses code to create a public, decentralized ledger where scarcity is fixed at 21 million units, removing any central authority's power to print more. However, cryptocurrency faces significant hurdles as a daily currency. Extreme price volatility makes it difficult to use for standard purchases, and the lack of a central authority means that losing a password results in your wealth vanishing forever. This flow map illustrates layering, where criminals break illegal cash into tiny deposits. The funds move through shell companies until the trail is buried. They then inject this money into a legitimate business. It emerges as clean income, hiding the crime within millions of daily transactions. From decentralized code to convoluted shell companies, people constantly build shadow systems to manipulate or protect wealth outside the traditional gaze of the state. Success in the market depends on which game you choose to play. Stock trading is a short-term sprint focused on volatility. It involves guessing market momentum and reacting to daily news events, a strategy where most participants lose money. Investing is a marathon. It focuses on long-term corporate earnings and the power of compound interest. Rather than watching daily price swings, investors choose quality assets they believe will grow over the span of decades. This strategy requires the patience to ignore market crashes. Warren Buffett built his fortune by identifying quality companies and holding them for 30 or 40 years, allowing the long-term growth of the economy to do the heavy lifting. Global finance operates as a dynamic system of leverage and trust, rather than a collection of physical objects. It relies on a set of rules that reward those who understand the underlying mechanics. By looking past the intuitive myths of tariffs, deflation, and debt, you can stop reacting to the noise of the short-term market. Understanding the real rulebook allows you to navigate the economy as a participant rather than a victim.